Hello there, my friends. Chris Marcus here with you on Inside the Markets on the StockPulse Network, and fortunate to have a return guest today, Dave Kranzler of Investment Research Dynamics, who covers the gold and silver markets and pretty much everything in the markets. I know he has his short sellers journal, which is coming in handy. And actually, I have made money on a trade recently because I've been taking your advice, Dave, and shorting some home builders. With that said, one of my favorite guests and one of the sharpest minds I know of in the financial industry today, David. How are you doing, my friend?
I'm doing well, thanks. I appreciate you saying that. You know, you're fortunate to have me. A lot of people might think it's unfortunate, but
Well, I actually get some viewer and reader feedback. They say they love when I bring on Denver Dave. So glad to have you back on here again today and
thanks for having me.
figure out really what's going on. It's a wacky financial environment, not just gold and silver, but all the bubbles that are going on. So if you want to kick it off, give a quick interview of what you're looking at today and any thoughts on how this whole debacle is unfolding.
Well, I mean, it's, you know, what you referred to as wackiness, I think is the market's reaction to 10 years of central bank intervention and rigging. And, you know, the pendulum's starting to swing the other way, and the intervention, well, at least optically on the surface, it looks like the central banks are pulling back from intervening because they're not, you know, our Fed has stopped printing, and they're slowly reducing their balance sheet. It's about on the same scale and rate of shrinkage that they're applying to raising interest rates. So it's, you know, at a snail's pace, they're you know, I wouldn't even call what they've done yet an unwinding, a start on unwinding what's been done over the last 10 years. But I mean, if you look at a long-term chart of the Fed's balance sheet, you know, the decline in the size of their balance sheet barely registers. So, and so I think what we're seeing is, and you know, the other thing is that the advent of this HFT-driven computer hedge fund trading has really kind of, you know, if you look at the bubble and put it in terms of a balloon, and you blow up the balloon as tightly so that the surface of the balloon is about as tight as it can get, and then crank it just a little bit more right before it pops. That's where we are that's what the hedge fund algo trading is done. So it's the analogy I like is what's happening in the markets is when you spin a top and it starts to wobble and fall, it starts to wobble the fastest, and it has like the largest kind of circumference and diameter right before it falls. And apply that analogy to the markets, and I think that's what we're seeing in terms of the increase in volatility. And, you know, one week the market's up 1,000 points, the Dow's up 1,000 points, and then boom, a day like yesterday comes and it gives 600 of it back. So, you know, that's what I think is going on. How's it going to resolve? I mean, ultimately, and again, I have no idea on the time frame, but I think we're going to go a lot lower in all the stock markets around the world.
Yeah,
and I don't think it matters whether the central bank stop intervening or not. I think at some point the laws of economics and nature kick in, and we're just going to go lower.
Yeah, and I appreciate you mentioning that, Dave, especially you touched on the volatility, because in many ways it reminds me of the old days back in the trading floor. Now everyone talks about when Lehman blew up in September of 2008, but as you well know, a lot of the chaos started even early in 2007. And I remember towards the end of that year, we'd be sitting there, I was trading equity options. You know, you'd have your P&L showing how much you were up or down, and then the last hour of the day, the market would either go up 500 points or down 500, and it was almost like the first half of the day didn't matter, and it was just wild, which we saw the effects of a lot of the bubbles and the malinvestment being exposed then as interest rates were going up. And that's the feeling I've had wondering if whether the bubbles have officially begun popping or if we're just getting close. But when you see Facebook randomly drop one day, or a lot of these tech stocks, which, and again, I know you write a lot about Amazon. I calculated it's up as it was my math or calculator broken about 4,100% since in the last decade. But again, that's what, from an Austrian perspective, you would kind of expect with the rates going up, and seems like we're seeing now.
Yeah, well, Amazon had a phenomenal run. It became, you know, a must-own stock for every hedge fund. I think at one point it was the most widely held stock by hedge funds. I mean, it was just, I mean, that's an example of all the printed money that circulated throughout the financial system, and a lot of it landed in hedge funds. And it was just supply of dollars chasing a limited supply of Amazon stock.
Right.
And that's what drove it higher. It certainly wasn't any, you know, the fundamentals. I mean, if you tear apart Amazon's financials and try and calculate a true cash earnings per share, you know, as opposed to a GAAP earnings per share, most of that's non-cash earnings. You know, Amazon trades at a ridiculous price earnings ratio, and its profit margins are razor thin. I mean, much thinner than your average retailer. So, and in fact, their profit margins have been driven by their cloud services, and that's part of what started the sell-off in the stock when it reported in late October, was the fact that the cloud services revenues grew much more slowly than the market was expecting. Well, I mean, Amazon's starting to feel the effects of the large tech elephants invading the space. Google, Microsoft, IBM, Oracle. I mean, all those companies at a point are going to take a lot of market share away from Amazon, and that's been the only source of Amazon's organically generated cash flow. It's not its retail internet type business. So you know, Amazon's a good example, because I think the stock was down, again, these numbers are off the top of my head, but from its top to where it bottomed out before this latest market bounce, I think it was down something like 20 or 22%. So, and then it bounced back. It was up, I think it was up $75 yesterday, and then it started to sell off pretty hard this morning, and then something came in and saved the stock market. It certainly wasn't any specific news, and Amazon bounced. So, but I think Amazon's a good example of it's a market leader. It's an indicator of the direction where this market's going, and it's going a lot lower, and I think Amazon's going a lot lower.
Which I know you write about in your Short Sellers Journal, which people can find out about on Investment Research Dynamics. And I am grateful to be a subscriber. And in there, you've been talking.
You are a subscriber.
What's that?
I'm grateful you are a subscriber. Thank you.
Well, I'm darn fortunate, because again, you know, sometimes I like focusing a lot on gold and silver, and there's so many things going on in the market. And you know, as I've gotten older and left the trading floor, I realize really having good sources of information that, you know, you vetted and know are thorough and can trust is really an important part to be able to succeed in what's going on now. So I think you are one of those resources. And in the journal, you've been talking a lot about shorting some of these tech stocks and also real estate. We've seen them pull back a little bit this year, but I'm guessing we're still pretty early in the game for people who, whether they have some of these stocks in their portfolio or are wondering if it's time to sell, or if they're thinking about actively shorting something in some fashion. Are we still early in that, or how would you approach that I know you're doing that with your fund and yourself.
I mean, it depends on if you're looking to trade the market or you're just going to put on long-term fundamental shorts. I would not be long tech stocks right now. I wouldn't be long home builder stocks. I mean, the home builders from their peak in late January, or at one point they were down 35%, and they're still down something like 30%, even with the bounce that they had over the last couple of weeks. And we saw this in 2005 to 2006, the home builder index that I follow, the Dow Jones Home Construction Index, it was down 51, it dropped 51% over 12 months before it had a counter trend bear market bounce, and it bounced 30%. So, this time around it dropped 36%. I don't think the bounce we've seen over the last couple of weeks is the proverbial bear market counter trend bounce yet. I think we're going to go a lot lower. That the housing numbers that I've been looking at and the reports I've been getting, it's a great thing about having my subscriber base. A lot of them send me local reports from around the country. And, Zero Hedge posted an article from the Seattle Times last week that confirmed, what the reports I've been getting from Las Vegas, Dallas, the Southeast, the Northeast. It looks like the housing market literally fell off a cliff in October. I mean, we're talking about, I know for the first couple weeks of October, there were counties in Las Vegas that were down, 40% year over year in terms of sales volume. One of my subscribers is in Texas, and he's a realtor, and by his calculations, the Dallas-Fort Worth pending home sales for October are going to be down at least 20%. I mean, those are big numbers. And I don't think those expectations are reflected yet in the sell-off that we've seen so far in the housing market. It's going to get a lot worse. So, I mean, as you know, at this point, after 30+% decline in the sector, I don't think you want to screw around with short-term market timing. Right. Just put on some 18-month or 24-month out of the money puts and forget about it. And you wake up a year from now, your puts are probably going to be doubled or tripled or more in some cases. So, Beazer Homes reported this morning, and the headlines, they beat their revenues, they beat their earnings, they paid down debt. Well, I just looked at their numbers, and their new orders year over year actually declined in the latest quarter, and that's not great.
Right.
And did they pay down? Yeah, but they paid down debt, but they replaced it with just slightly lower interest cost debt. So, and Beazer stock is up 30% this morning. I mean, it's a low dollar price stock, but Beazer is probably going to hit the wall. I mean, it's still way over leveraged versus it's the size of its revenues and the cash flow it generates. So Beazer's been bailed out by the capital markets for the last couple of years. It would have hit a wall, wouldn't have been able to make its debt maturity payment a couple of years ago, but it was able to refinance it. But the market will only give it short-term refinancing money, and so it has to keep rolling that over. We saw what happens in 2008 when over-leveraged companies can't roll over their debt obligations. They hit the wall.
Right.
So, I still think we're in the big short moment for the real estate sector. So,
yeah, and speaking of which, the big short and what happened in 2008, I find it fascinating. Trump, for whatever reason, lately has ratcheted up the Fed criticism. And of course, on one hand, anyone who's critical of the Fed, usually I'm seeing something in common with. Although, aside from the fact that he was talking about auditing the Fed and a gold standard and how the stock market was a bubble when he was campaigning, nonetheless, he's saying the Fed's raising rates too quickly. And as I know you well know, we've had 7 years of 0% rates, another 3 years of 2% or less, in addition to the $3.5 trillion, that at least is what is stated on the Fed's balance sheet. How much is really out there, God only knows. Yet, if Paul Volcker had to raise interest rates to 20% back in 1980, and even Greenspan, after he lowered rates to 1% for a year between 2003 and 2004, and then he started raising them, his final hike before he reversed course in 2006, he got up to 5.25%. And yet we're seeing this thing tumble over when we're just hitting 2%. So makes you wonder. I mean, you're seeing this now, but what happens if, I mean, what is even a fair interest rate at this point? And I think I know your answer, but is there any chance that any of this market could withstand that?
What do you think my answer is?
I'm going to say, is it 500%, 5,000%? I mean, it's a bankrupt, insolvent bubble that's popping, and it's just curious to see the. I've wondered, is Trump getting ready to blame the Fed? Do they know it's about to topple over, and this is just the politics? Or do you have any thoughts on that? I can't figure that one out, as well as who's actually buying the treasuries remain the big mysteries in my world these days.
Well, I mean, Trump makes his money on other people's money, taking other people's money and buying real estate. I mean, every real estate developer wants interest rates as low as possible.
Right.
I mean, if Trump probably thinks money should be free because then he can develop really great, beautiful properties and give investors a rate of return. So, Trump won't be happy unless the Fed takes interest rates back to zero or even takes them negative. So, Trump's not a good acid test for financial management. I mean, as you pointed out, when he was campaigning for president, the Dow was at 17,000 and he called the stock market a big, fat, ugly bubble. Well, now the Dow's at 25, almost 26,000. So it was a big, fat, ugly bubble back then. What is it now? To answer, there's a couple ways you can answer what's a fair interest rate. I mean, if you want to look at kind of natural interest rates over time, typically interest rates are set about 300 basis points or 3% above the inflation rate. Well, we can't even agree on what the real rate of inflation is. We know it's more than what the government's telling us it is, 2.5% on the CPI index or whatever it is. I mean, take a realistic basket of goods that people have to spend money on every day or every week, and then let's measure the rate of inflation, add 300 basis points to that, and that's probably a fair level for the Fed funds rate. Now, there's another way to also look at that. Let's imagine a world where the Fed can't print any money, and the U.S., in order for investors to participate in future Treasury fundings and refinancings, the U.S. has to agree that it's going to start paying down debt. Well, what would happen if the U.S. had to start paying down debt? I mean, essentially, the U.S. is technically insolvent. So what rate of interest would the market demand to buy U.S. debt or any debt of any insolvent company? You wouldn't be able to. So in that sense, a market rate of interest for, say, 10-year Treasury bonds is undefinable.
Yeah.
The only thing that defines the Treasury market now is the fact that the U.S. can print money to pay down the debt. So technically, the U.S. can't default until it's no longer able to print money. And who knows, when that event will occur. But, the simple answer is interest rates, the fair natural rate of interest. I guess I don't want to say fair, but the natural rate of interest based on history for the Fed funds rate is significantly higher than it is now. And if the Fed were to jack up interest rates that quickly, the whole system would seize up, as you've pointed out.
Yeah, plus obviously if interest rates go up, then the interest expense goes up. Of course, there's no money to pay for that. Although I like that you pointed out something I've been thinking about for a while, for a decade even. To me, the whole thing with gold and silver, I've felt comfortable with that pretty early on because I can't find a way it's not past the point of no return, the current system as we know it, because either A, they keep rates low and eventually blow out the dollar, or B, you raise rates and the thing comes tumbling down as we know it, which makes me wonder. We hear a lot about a financial reset. Again, I've been more of the school of thought as the years go by that a lot of what we think is natural trading is engineered, rigged, pre-planned. But it's almost, what other outcome is there outside of just really ramping up the presses, even faster than we saw before, or else, I mean, the numbers are simple enough. We didn't even talk about however much you calculate the unfunded liabilities. Although there was an article, Mitch McConnell is suggesting making cuts to Social Security and Medicare, and I thought maybe I was dreaming, or but it almost seems, and especially with Trump having the bankruptcy experience, can you see any other way this ultimately ends? I mean, it's like it has to have that ending.
Trump's had, I think, the Trump casinos went through chapter 33 so chapter 11 times 3 before he lost control of them. So, who knows what really is the truth about Trump's empire.
Right.
So, he's basically been a product of lascivious capital markets ever since the Drexel era. He was originally financed by Drexel. So, and then, in the 90s, Bankers Trust, which I worked in I traded in junk bonds at Bankers Trust in the 90s, and Bankers Trust and DLJ. And back then, I guess, First Boston or Credit Suisse, those banks essentially replaced Drexel as the junk bond heroin providers for guys like Trump. So, I don't know how this whole thing's going to unwind. I just think it's not going to be pleasant for any of us, even if you own gold and silver. I think owning gold and silver gives you a chance to survive financially and see what it's going to look like on the other side of whatever's coming. But then you have to ask yourself if you really want to see what it's going to look like. I don't know that I do.
Yeah, and especially the last question I had for you this morning, in terms of gold and silver, and we hear a lot about being careful about paper gold or silver. Make sure that you have access to your gold and silver, because as we talked a little bit about last week, I'm surprised I haven't seen more coverage of this, but apparently Venezuela asked the Bank of London for, I think it was about $550 million worth of gold back.
14 tons.
And I guess there's debates of whether this is officially announced or not yet, but the story is out there that basically the Bank of London said no. With the unnamed sources saying that it's due to the sanctions or due to them speculating that Maduro is going to take it and keep it, which may well be for all I know, although still I'm not sure how that provides justification that you can just say, no, we're keeping it. Am I missing something here, or did we not just experience a default in the gold market, at least if that story is accurate as being reported?
Well, I mean, yeah, I think it's accurate. I mean, the Bank of England doesn't deny it. I think the reason why you're not hearing much about it is, based on my observations over being involved in this sector for 18 years, no one outside of the small coterie of what some people call gold bugs, the gold investing community and the truth-seeking community, really cares about gold. I mean, you've seen, I think is it the Mark Dice videos where he's on the street and he offers people the choice between a half-ounce gold coin or a Hershey's bar, and people take the Hershey's bar. They look at him like, he's from Mars when he's showing them the gold. I think he's done this. I've seen the same video when he does it with silver as well, silver eagles. So, I mean, that tells you, where people's head is at in this country in terms of, how much they think about gold and silver. In other words, they don't think about it at all. I mean, culturally, gold has been, and the idea that precious metals are real money and a real currency has been washed out of our educational system and out of our culture since the early 1970s. I mean, well, you went to Wharton, and that was, in the 2000s.
Hey, why are you taking cheap shots there? Come on.
No, that doesn't surprise. No, Wharton's a good school. It's hard to get into. But, I went to the University of Chicago.
Harder to undo what you learn there, but.
Well, yeah, I agree with you. I went to University of Chicago in 89 through 91. And, it's like Wharton. It's a pioneering school in finance. And I didn't hear the word gold mentioned once in any of my finance or business policy classes. So, in fact, there's only one class that I took that was worth a damn at that school, and that was a very high-level accounting class that really taught me how to dig down and pull apart financials and get to the truth. So that's why you're not hearing any, real news about this Bank of England story. And they gave a couple different reasons. So they had to throw as much brown stuff at the wall and hope some of it would stick. Well, it doesn't stick with guys like us because we know the truth. They said they wanted clarification of the Venezuelan government's intentions for the gold. Well, that's none of the Bank of England's business.
Right.
It's Venezuela's gold. They have title to it, right? They should be able to do whatever the heck they want with it. The Bank of England can't tell them what to do with their gold. Unfortunately, Venezuela made the mistake of leaving their gold with the Bank of England, and now they're screwed. Another excuse they gave is there are concerns that Mr. Maduro may seize the gold, which is owned by the state, and sell it for personal gain. Well, guess what? That's the citizens of Venezuela's problem, not the Bank of England's problem.
Right.
Venezuela wants its gold back. Maduro is the president of Venezuela. He's the leader. He's the chief policy decider. He wants the gold back. They should have to give it back to him. If Venezuela had an army the way the U.S. had an army, I don't think it would be an issue. So here's what I think. I mean, it's simple to say, well, the Bank of England doesn't have the gold to return, and that may be entirely possible. What I suspect is that now, and again, 14 tons of gold in the context of large international, institutional, and central bank transactions is nothing. It'd be like you and I, trading dollar bills, playing liar's poker with a dollar bill. My guess is that, and the accounting and the scrutiny of the bars is at least when you put them into storage is very intense. So there's a registry somewhere that has the serial numbers of these bars and under the Venezuelan account. And my guess is the Bank of England doesn't have those specific bars that Venezuela originally put into the vault. And so even if the Bank of England decided that they were going to, well, this was another thing. They said they were having trouble getting insurance for the shipment, which is total bullocks.
I did hear that. It's amazing.
There's total bullocks. I mean, again.
They can ship the missiles and the tanks, no problem. But anybody asks for their gold back, oh, we don't have any boats. We don't know how to get it
14
there.
tons of gold and getting insurance for it. I mean, 14 tons is an odd lot. I mean, just from the export numbers, there was something like, I don't know, I think it was the month of September. There was something like close to 200, I think it was 200 tons of gold that was shipped from England to Switzerland for refining. I forget, it was a huge number. It was way more than 14 tons. And they were able to ship that without a problem. The LBMA was able to get insurance for that. So you're telling me the Bank of England can't get insurance for 14 tons? It's nonsense. I think what the problem is they don't have the original bars, so that if they were just to pull 14 tons worth of 400-ounce bars and ship them back to Venezuela, and Venezuela would say, hey, these weren't our bars. These aren't the serial numbers that we have on record as originally putting in your vault. Where are our bars? Because then it's like, you got to have them assayed. You got to have the bars, are these counterfeit bars? I mean, there's all kinds of complications here. So maybe the Bank of England doesn't have the gold period to ship back. Who knows? They probably can get their hands on 14 tons. Like I said, it's not a large amount in the context of international transactions. Part of the thing is, I'm guessing they don't have the specific bars, and if they shipped them back, Maduro's the kind of guy that would make that public and point out, look, what the gold bugs are saying is true. We want our bars back. I mean, it's been documented and on record that a lot of the gold that the U.S. has shipped back to Germany on Germany's repatriation request were not the original bars that were put in there. And a lot of it was like reconstituted old gold coins that were melted down and reformed into bars. So that's sort of a long-winded answer for what I think is going on there. It's certainly foul play.
Yeah, which normally doesn't happen when everything is normal and things are good. Whether that means we're close to the break point, I guess remains something we'll find out in time, although certainly stunning things happening. And fortunately, people can stay tuned on that in the Mining Stock Journal. Perhaps in wrapping up, you can just let them know about the Mining Stock Journal, short sellers, which talked about a bit today, and I think are great resources, especially with the environment we're entering now. So if you can let folks know where they can find that.
Sure. My website's investmentresearchdynamics.com, and there's links at the top that give you information about Short Sellers Journal and the Mining Stock Journal. The Short Sellers Journal is weekly. I send it out typically late Sunday afternoons every week. And then the Mining Stock Journal is bi-weekly, and I send that out every other Thursday evening. So, and it's newsletter format, email delivery based, and I go over my take on what's been going on in the markets. This is for both issues, both journals, and then I present stock ideas, short ideas, or mining stock ideas.
And I can confirm that after 11 years on Wall Street, I guess almost 7 years now since, the stuff you put in there, people will not find in CNBC, Wall Street Journal, which aside from amusement purposes, I kind of tune out at this point. So again, if folks want to get a handle on some of these things that are going on before they happen, and that's certainly where you can find them. Some great resources. Dave, thank you so much for joining me again today. I think you're doing a lot of great stuff that's helping people through what's coming up. And we'll look forward to having you on again soon, my friend.
Thanks, Chris. I appreciate it. Thanks for having me on.